It's Brian Preston, the money guy.
Here's the second thing that you can do before the end of the year to really help boost your financial life. It's understand that tax season ends on 12/31, not April 15th. So the tax planning that you ought to be doing should be taking place right now, not the week before you get ready to pay your taxes next year.
When we've done tax shows at year-end, tax planning shows specifically, we've done whole shows on this, not just a section of a full show. I can go ahead and summarize this very quickly. Typically, with year-end tax planning, you want to be deferring income that you can, and you want to be accelerating deductions. So all my procrastinators, once again, this is your opportunity to really think about what can you do to make your income situation seem as low as possible, but your deductions come up as fast as possible so you get more benefits out of both of those things.
So even though that's kind of the general overarching advice, and that holds true in most tax planning environments, we wanted to walk you through some of the things that we look at, some of the things that we as advisors think about as we come to the end of the year. We're going to talk a little bit about what they are and how you might be able to use them. The first we've talked a ton about loss harvesting. Obviously, when we have losses in the market, there's a great opportunity for us to go sell those loss positions, capitalize on those losses, and buy a similar but not identical holding. So if I have a small cap index, I might want to sell that and buy a different small cap index, international, and so on. By doing that, we don't change the overall investment allocation, the structure of our investments, but we change the individual holdings so that we can capitalize on those losses, and we can use those losses to offset all capital gains that we have this year. If we do all that, then we can still do $3,000 of ordinary income. And if we still have some left over, we can carry it into future years. So it makes sense when it comes to losses to get while the getting's good. And unfortunately, the getting has been real good this year for losses.
Yeah, and if you want to deep dive on this, we did an entire show on loss harvesting. I mean, we fill you to any level you want to know. We've got you covered, so go check out that show. Another thing we always try to do at year end is capital gain avoidance.
It's a big one.
This year, the distributions aren't as big as they've been in some of the big years where we've had outsized performance. But still, like I know right now, I have a few clients that I've got to make some phone calls because they had some sentimental holdings that they had and some other things that aren't a part of our typical stables of funds. But these things are still going to be issuing out like a 13% capital gain or distribution here at year end. That doesn't make sense.
Now, Brian, let me stop you there because when a lot of people fall into this trap, they say, whoa, hold on, there's a fund that's going to have a 13% distribution. Well, I should go buy that right now because I'm going to get a 13% rate of return as soon as that pays out. Is that the way that it works?
Well, if only it was that simple. We could just go get a list of all the big distributions. Because, by the way, there's been, just go ask the people who own the Vanguard Target Retirement funds last year if this strategy worked. It doesn't work because guess what happens? You do get the distribution where you will end up paying the income taxes on that if it's in a taxable account. However, they adjust the net asset value, the NAV of those shares, so that they lower the price to account for the distribution. So no, it's not a win situation. Your market value of the holdings adjust, and it's still worth the same amount. It's just now you owe a bigger tax bill on the portion that was distributed out to you.
I was going to say, the distribution is net neutral. All you are getting is a tax bill. So what is the strategy there? Go look at all your holdings. Go look up all the distributions they're going to have, and if it looks like the distribution that's going to pay out is greater than your embedded gain in that holding, perhaps you don't want to stay in that holding through the distribution date so you can avoid that tax payout. That may not be something you want to take on.
Yeah, they do publicly disclose those distribution dates, on the dates that you have to own it, the date that they're going to distribute it. And by the way, they don't love it when you do this strategy. So, that's something that just to being completely transparent, you need to understand the rules that the fund is trying to implement to keep you from doing things like this, because there are some things they do. But pay attention, but it is definitely still a powerful year-end planning thing that you ought to pay attention to if you can avoid these capital gain distributions if you're not actually getting a market value out of it. The other thing we look at is Roth conversion analysis.
Yep. We always think, especially for our folks who have more control over their income, or perhaps you're someone who's retired and you're living off a portfolio income, around this time of year, it makes sense to do a tax projection and just look based on the pension income, Social Security income, earned income, portfolio income, any types of income you have, you ought to know where you fall this year. And if you fall into one of the lower tax brackets and there's some room to work with without tripping over some of the negative things we'll talk about in a moment, then you may want to consider converting some pre-tax assets to Roth. And another great thing about doing that right now is if you convert assets right now to Roth, you're doing it during a downturn so that when we do see that recovery and when the market does pop back up, you get to ride that roller coaster back up the mountain on the Roth side, the tax-free side of the equation.
Yeah, definitely. While the values are compressed, this is a great time to get more bang for the buck out of those conversions. There are some tripwires you've got to be careful about. I always talk about the taxability of Social Security, your Medicare premiums. If you think about, you just have to make sure, because there's so many different things that you can actually trip over while you're doing these strategies, but it does make sense to definitely measure twice, cut once, and take advantage of this while we're in these volatile years. This is another one of those silver lining opportunities in a year that might be a troubled year. Another thing to look at, this one's kind of a contrarian thing, because you just heard us talk about capital gain avoidance.
Yeah.
And here I am, I'm going to tell you, some people, they might want to actually accelerate their capital gains, because a little known thing in the tax policy is that if you're a single person with your income being less than $41,675 or a married couple with income less than $83,350, you fall into a 0% capital gains rate. That's right, 0%. It's free. So there's potential, if you're in a low income situation, you can actually accelerate capital gains and pay zero taxes on that. You ought to look into it.
So maybe you're that person who grandma or grandpa left some stock to you one day and that's blown up, or your parents put stock in your name and your baby, and you have these huge embedded gains that you've never been able to do anything with. Or maybe you had that mutual fund that you bought at the right time and it has this huge gain. If you fall into this 0% capital gains rate, it does give you a really interesting opportunity to be able to exit that in this year if you've already utilized all of your capital losses. So make sure, if you are in one of those income brackets, you don't do something that would potentially cause you to trip over that and cause your capital gains to become taxable. It's a really important thing to make sure you keep track of if you're anywhere near those limits.
Yeah, especially if you're retired. I mean, I've just gone through 2 of these for clients where we were trying to figure out, is this a Roth conversion year or is this a zero capital gains year? You know, because it's kind of an either or, and we did a full tax projection. Go do that for yourself too. I think there's a lot of value in trying to figure out, are there some unique planning opportunities in this volatile financial year? And then we put this one in here, another one. This is another procrastinator's delight, is retirement plans. We want to make sure that, you realize those salary deferrals, you can only put those in by 12/31. Now look, the profit sharing and some of the other things, if you own the company, can go back retroactively to the previous tax year, but your personal contributions, the salary deferrals, have to go in by 12/31. And this also brings up a point, Bo. Solo 401ks.
Oh yeah, yep.
Look, most people, like when you go get your taxes done next year, if you're self-employed, really the only tool you have to go backwards is a SEP IRA. They will say, okay, good news, we can deduct, we'll set up a SEP IRA. We'll be able to, deduct, basically the employer will provide, the small company you own will make a contribution to a retirement account, and it'll be somewhere between 20 and 25% of the profit, capped out at, $61,000
I think so for
this year.
Yep.
So that's what will happen. But since we're still in 2022, you have the opportunity. You could set up a solo 401k if you meet all the criteria. Look, there's some things you got to do, because remember, success does create complication. Sure. But you not only get to do that amount that went in for profit sharing, the 20 to 25% of income, you also get to do that $20,500 as a salary deferral for you. And if your spouse works in the business, also for them. There's a lot of things, but it has to be set up before that 12/31 deadline.
And the other thing that we see, and we see this all the time, every now and then they increase how much you can put into a 401k as a salary deferral. Well, perhaps you were set up a couple of years ago to max out at $19,500, and you didn't realize that the limits increased to $20,500. A really good thing to do right now is go look at your most recent pay stub, or go look at your 401k account and just say, hey, am I actually on track to max out? And while you're doing that, recognize they just increased the limits for next year. So you should go ahead and start doing the math to think about, come January 1, how do I need to adjust my withholdings to make sure that I don't just withhold $20,500 next year. I actually withhold the $22,500 that it's going to for 2023.
And for all my 1973 people out there, remember, because there's going to be a big inflation adjustment on those catch-ups and so forth. It's not when you actually have your birthday. It's the year that you turn 50 that you can actually make that. So January, it doesn't matter if your birthday's in December. If you were born in December of 73, it doesn't matter. You can go to January of 2023 and start doing those catch-up contributions.